if our processes are excellent, our outcomes will be measurable. And if our outcomes are measurable, we can improve infinitely upon those outcomes. Keep expectations in check. You're not going to get a 10,000% winner every single year as an investor. You're not going to get a 500% winner every single year as a trader. Make it about yourself and not about others. Confidence is the biggest thing. If you come in and you're kind of iffy and you're kind of scared of the markets, or you go into a boxing match and you're super scared of who you're facing, you're probably not going to do really well. Money's not going to buy happiness. That's true in life. And that's also true in trading. Never give up. Essentially, a good trader is a trader that never gave up in the first place.
All right, welcome back, everybody. It's my honor to introduce our next speaker for the Traderlion Conference, our very own Ameet Rai. Of course, you guys know him as the co-founder of Traderlion, as well as DeepView. He's an extremely experienced swing trader with over 14 years of experience, the founder of also the HV Edge methodology. And today he'll be presenting 10 pillars of any trading system, and we'll be going over some specific trade and stock examples later on as well. Rai, thank you so much for being here, and looking forward to diving right in.
Awesome. Yeah, thanks for having me on. I hope you guys have been enjoying the conference. The first weekend was really, really good. And following up with Stan Weinstein and Jason Shapiro, I hope I can just top that somehow and do as good as they've done as well. So the topic of my presentation today is really going to be a checklist for you to, sit there and say, okay, I'm doing this in my trading and I'm not doing that. And I'll give you guys 10 things that I feel like any trading system, under the sun should have, as you go through, and build build the way you're trading year over year, month over month, and quarter over quarter. So at the end of this presentation, I really want you guys to comment throughout as to if you're doing this already, if you aren't doing this, how do you plan on tackling it as well? I'll be very active in the comments as you guys watch the presentation. So a little bit about me before we begin. An engineer by trade, so a lot of my presentation today is really going to be focused on processes. How do we build excellent processes to get very definitive and the outcomes that we deserve based on the efforts that we put in. I'm the co-founder of Traderlion and DeepView, both amazing companies. One educates people. We've partnered up with some of the best in the world, like Oliver Kelly, Stan Weinstein, and bringing them in to educate you guys, and then DeepView to build a software that we've always dreamed of, me, Richard, Ross, and Nick. So before we begin, a little bit of, I have a kid on the way, so I thought I would put this in the presentation just to make it memorable. So life has been pretty different and is changing quite a bit for me behind the scenes. The kid's going to be on the way in November of this year. Super excited about that. All the dads that are watching, definitely comment with all your advice. I could use any of that just to prepare for what's coming my way in November of this year. So with that, let's get into the meat of the presentation. And really, it's a checklist for you guys to see if you're doing any of this. I strongly believe I've taught thousands and thousands of traders over the past 8 years since we started Traderlion. And this is kind of a checklist built upon that, having thousands of conversations, being a mentor to many, many people who ended up, competing in the USIC as well. And also just hearing about their problems and what they lack and how they became profitable, or if they're not profitable, how they can become profitable. So this is a checklist. Please, check it. If you're doing all of this, this is amazing. That's great. You're probably a phase 4 trader, which I'll explain in the next few slides. If you're not doing this, you need all of these kind of components to come together for you to be that phase 4 high performance trader, which we will discuss today. So with that, the first pillar of anything in trading is building your trading foundation. A lot of traders will come in and the first thing that they want to do is they really want to just make money, right? That's their only objective. They're in it to win it, and they don't really see anything else when it comes to trading. The first point that I really want to make is you want to understand your why. The basics of knowing your math and understanding what compounding is lacking. And this is all based on conversations I've had and thousands of mentors I've I've met, spoken to and helped along the way, they do not understand the fact that, the basic math of if you're up 50% and you make 10%, how much are you up now, right? So understand compounding at the very core of it. Once you understand those very basics, you'll have these aha moments, and you won't really push for yourself and look at 100% gain as unachievable. You won't look at 80% gain in the first 5 years of your trading as unachievable anymore. So understand the basics of compounding. The second is analyze what's going on around you. A lot of traders will tend to pick something very early on and make it all about that. But I feel like the opposite is very true. You want to see the success that you have around you, right? If I see Oliver Kell making 941%, I see Stan Weinstein building a stage analysis system, I see Jason Shapiro talking about contrarian trading. You want to be open to all of those ideas and ask what they're doing. They have proven track records. They have compounded their gains really, really well. So analyze whatever it is that they're doing and how they're approaching the market. And eventually you'll find your niche. You'll find the way you want to trade in the markets just based on that. And I feel like that's really important for traders to do, not just pick one thing, try to, consume everything, and then you'll find your way as you go through this journey. The third is responsibility and accountability. At the end of the day, you could sign up for anything, you could pay for anything, but you're not going to, money's not going to buy happiness. That's true in life. And that's also true in trading, right? So you could go out there and spend all of it, but it's for you to take that responsibility, take that accountability, to internalize what you're seeing. This conference as well, as you soak in that knowledge, right? You have to go out there and then be accountable to go and apply it, see what works for you, what doesn't work for you, and how you could get better as a trader. The last bullet that I have here is knowledge and experience. A lot of people feel that you can have knowledge or you could buy experience. You cannot buy experience. What happens is you get all this knowledge in place, you bits and pieces of your trading from different traders, from different investors, different books that you read. But as you apply that knowledge, you gain that experience over time. So experience it cannot be bought. There's no shortcut. There's no shortcut to experience. There's also no way you could purchase it as well. So it's a mechanism of time, and the journey of and the beautiful journey of trading takes time. You will have these failures, which will make you better. You'll have successes, which will put you in a place where you feel like you're going to get super greedy, and then you lose it all again. So all of this is a mechanism of, you accumulate knowledge, you go apply that knowledge, and the application of knowledge is essentially how you build experience. The second bullet that I have is the phases of trading, really. So there are really 4 types of traders that I've spoken to over the past, I would say 8+ years, being a mentor to many. You'll get the typical trader who has, very big, very small winners, but very big losses. So they have a downward trending equity curve. They're unprofitable. They will have this success in the markets, which will which will boost them into overconfidence, really inflate their ego. And then they place that trade where they lose it all, but their losses are about 4x their wins, or 3x their wins. So they're basically in a downward trending equity curve. That's your unprofitable trader. The second type of trader I've spoken to is the boom and bust. So the boom and bust is essentially your wins are equal to your losses at the end of the day. You're not making any progress. You know that sometimes you're very disciplined and you make money, and you know that sometimes you're very undisciplined and you don't make money, but you're not getting out of it because you lack system, you lack strategy, you lack process, and you lack the execution of those processes to stay disciplined within your trading. The third type of trader is a profitable trader. So they have their processes down. Their wins are bigger than their losses. They become undisciplined sometimes, but they get back to, on the right track by themselves. They're good in the markets. They make money when they feel like, when they concentrate and execute upon it, they're good. And sometimes, they take a couple of weeks off or a couple of months off, come back. They know how to trade. It's just up to them to kick it to the next gear, right? And that's the last type of trader. And that's really what we all want to be. That's why we're attending the conference today. That's why we're listening to the speakers that we had last weekend, this weekend, and will next weekend. the high performance trader. The high performance trader is when you have a system, you have a strategy, you have an edge in the markets, and you're executing upon a framework that you've built for yourself through gathering knowledge, applying that knowledge to then gain experience. You're responsible and you're accountable. You've gone out and looked at all strategies and see what works for yourself, and you understand the concepts and the basic math of compounding. That's what a high performance trader is at the end of the day. They figured it out, and that is, the unprofitable trader, the boom and bust trader, the profitable trader. They're all chasing that high performance type of, the performance phase in trading. The last thing is being very honest. So the common trading problems, speaking to people, we always tend to suppress what makes us kind of feel bad about ourselves, right? We always tend to ignore things that we know are wrong, but we don't address them to get better. So a boom and bust trader, if they don't get focused on system strategy, edge, entry tactics, they will not be a profitable trader. If a profitable trader does not get serious about their risk management system, or doesn't optimize their position sizing system, they will not become a high performance trader. So addressing your trading problems is really at the core, and that comes through being honest to yourself. So a lot of traders that I see in the unprofitable phase will hop to different systems. They will go from trading RSI on Monday. By Friday, they're trading MACD. By next week, they're into stage analysis all of a sudden, and they're very distracted. There's no real focus. They want to try things, but they're changing too frequently, and they're not having that feedback, or that feedback mechanism, or that feedback loop give them the enough so that they could get the flavor of winning, and they really hone in on something that is starting to work for them. Second is oversizing. Traders tend to feel good about themselves when they place a trade, and then very quickly turn on the jets and say, I'm about to be, trade on margin. I'm about to do this and that. They start dreaming about things about, I'm going to buy this, I'm going to buy that. And that leads to, it's essentially fear and greed, leads to oversizing and blowups of accounts. Many of us have done it. I know many of you can confess that are watching it have done it as well. And that leads to the third point. Fear, greed, and FOMO really run the market, right? FOMO is something that you cannot kind of get rid of in your trading. But with a really, real solid blueprint, a real solid system, a real solid strategy, FOMO can be suppressed, right? You could negate FOMO in many different ways, though you cannot get rid of it. The last one is overconfidence. You want to avoid this. A high performance trader, a profitable trader, they all experience these phases of euphoria when they're making a lot of money. And it's really, really hard as humans for us to hold back. But that's where you need a system where, okay, if I hit this threshold, if I'm up 50% on the quarter, I deserve a payout. I take some money back, take care of your family stuff, have some mechanisms around you to make this a source of income for you, to continuously look forward to something, the next step in your trading, rather than thinking that you're a finished product, which we will never be when it comes to trading. So to build a trading foundation, you need to understand your why. Second, you want to be honest about what phase you're in at the end of the day, what type of trader you are, and you want to address your trading problems. So I'd encourage all of you in the comments or on a piece of paper, just write down what are your trading problems, where you are in your trading journey, and what is it that we need to address in your trading. And if we address those problems, I want many of you to go from being a profitable trader to a high performance trader, unprofitable trader to a boom bust, and a boom bust trader to a profitable trader at the end of the day.
And right, sorry, just jumping in before, can we go back one slide? I'm sure a lot of people are wondering, what are kind of the steps, or from a high level, things you need to master to go from that profitable trader to a high performance trader? Is it a matter of just kind of really dialing in on your process, mastering more your market cycle and knowing when to step on the gas? Is it a sizing thing? What are kind of the most important things to make that switch from, just having success when the market is good, protecting most of your gains when it sours, to, really performing, stepping on the gas at the right moments, and then protecting, most of your profits when the market isn't right for your system?
So it all depends on the type of trader that I'm really dealing with at the end of the day. So some people may have a great risk management system, but that risk management system cuts off their losses really, cuts off their winners really, really quickly, right? Or they have tighter stop losses than they should. If a 1.5% stop loss where, you could give it a little bit of wiggle room to have it 2 or 3, but they don't have that feedback. If I tweak this, what happens? Do my
Hmm.
results improve? Do my results get worse? They don't really look at it from that perspective. So it could be position sizing, could be risk management, could be a lack of market cycle system, could be a lack of just a pure feedback loop, which is purely related to journaling in your trading, knowing your stats, knowing your win rate, knowing your batting average, knowing your win to loss ratio, things of that nature. So it's very variable when it comes to a profitable trader turning into a high performance trader. There's no like, if you follow five of these things, you're guaranteed. It's trader A will lack position sizing, trader B will lack risk management, trader C will
Hmm.
lack a market cycle system, etc. So it's very, and we'll cover all of that in the upcoming slides.
Cool.
So the second thing on the checklist is mindset and edge. So the first thing that we will get into is mindset. So when it comes to trading, and I've said this earlier in the presentation as well, is we all want to make money at the end of the day. And that's always our first kind of primary instinct as humans. We wake up, we go to work, we come back, it's like a money-based system, right? All of our lives are based around money at the end of the day. With trading, what you want to do is really shift that mindset. As a trader A comes into the market, they open a brokerage account. They start off in the unprofitable trader phase. They might have this beginner's luck that happens. They might have things where they have, they enter GME and it's all, they feel like they're really good at the markets, and then the reality sinks in. So we all start as unprofitable traders, right? We're chasing money. That's where the mindset needs to shift, right? And I tell everybody that I mentor, I talk to, you want to stop, you want to have mechanisms in place where a 6% loss doesn't turn into a 16% loss, where you don't enter into a biotech and you got lucky and it gapped up and you hold that bag when it's down 50%, but you still believe in that biotech, right? So you don't have those mechanisms where you're all, your whole mindset is geared towards chasing money instead of I need to stop losing money for me to make money in the markets. The second is randomness. So trader A will wake up and today, they put on their hat and they say, I'm a day trader. And then the second day they feel like, now I need to switch it up and I'm a swing trader. There's a lot of randomness in their inputs as to how they eventually press that buy button. And there's also randomness as to how they sell. And all of this at the end of the day relates to lack of system, lack of strategy, lack of edge, lack of entry tactic, lack of risk management, lack of position sizing, market cycle, etc. Right? So consistency of inputs will always yield consistency in outputs. And it's very important for us to place things into our trading business plan that allow us to have consistent inputs, reduce our randomness, and focus on, if our processes are excellent, our outcomes will be measurable. And if our outcomes are measurable, we can improve infinitely upon those outcomes. If our inputs are random and we're focused on just making money, our outcomes will also be random, and it's hard to measure random outcomes at the end of the day. So the last is, it's a journey and not a sprint. So if you hear anybody ever say that, you pay this and you will have a shortcut to, going from an unprofitable trader to a high performance trader in a span of 5 to 7 weeks, that's not going to happen. And that's just the reality of it. It will take 5-6 years for you to even figure out, try all these different things, get your own processes in place, look at different trading systems and what fits your lifestyle. So it's a journey and not a sprint. If we have that mindset, when we have those down days in the markets, we will, we'll fight through those to make it as a high performance trader, which is what we all want. The second part of it is edge, be it fundamental edge, a technical edge, you talking to your barber, whatever your edge is in the markets. If you don't have clarity on what your edge is and you can't clearly state that this is my edge over the markets, These are the things that I look for consistently. You don't have a basis to even trade or place a trade in the markets at that point. So you need some sort of edge. Is it, if it's contrarian, like Jason spoke about in his presentation earlier today, if it's technical, if it's fundamental, if it's looking at transactions data for credit cards, whatever it is, any successful trader that I've ever spoken to, it's well defined, it's repeatable, they've studied it themselves, and it's the basis of their success in the markets and anywhere you go. So edge, mindset and edge is kind of your second thing on your checklist that, you want to make sure you have the right mindset and you're in it for the right reasons. And then the second thing is you want to have an edge where every successful trader you'll ever study has an edge in the markets. Let's get into the third checklist here. So third item, entry tactics and setups. So let's say I have an edge in the markets and it is to look at cash flow statements. I'm just going to pick fundamentals because I talk technicals a lot. I just want to prove a point. We're going to look at cash flow statements, and that is our edge in the markets when we see a certain, company exhibit certain fundamental characteristics in the market.
It's coming profitable or something for the first quarter.
Yeah. So let's say it's turning profitable for the first quarter. Now I'm going to go and, that is my edge in the markets. I've noticed this happening and I see that price correlates really well. I can 10x my investment by just looking at, balance sheets, income statements, and cash flow statements. So the second part of it is to define, have some consistency as to how you will enter that particular investment that you're making or a technical trade that you're making in the markets. The reason for having entry tactics is essentially to define risk and reward. If you can't define risk and reward as a technical trader, a fundamental trader, a person, Kathy Woods type of trader, it doesn't matter what type of trader you are. They always have, a defined criteria as to, I will enter here. If it doesn't work out, I will exit here. Be it a 20% stop loss, 25%, 5%, 10%, or a 3%. It's always defined when it comes to their entry and their exit. The second thing is it allows you to be in the driver's seat. So you dictate terms with the markets. If I have edge, if the company is turning profitable this quarter, I will enter that name. I'll place a 7 to 10% stop loss and I'll hold it for the next 3 quarters, for example. Now you, from your mindset, you're dictating terms with the market. You're looking at it as if, I have my risk set up and I know what my reward is going to be because I've studied my edge in the markets. And that's essentially what entry tactics are. You want to have clear and defined entry tactics. Again, the idea is to reduce randomness in your trading. Third is setups. So think of setups as combining your edge and the way you enter stocks, which is your entry tactics. And that is what essentially a setup is. It's a source of income for you in the markets. So I can have a technical setup, right? And a technical edge in the markets that I execute upon. I can have a fundamental edge and a fundamental entry tactic in the markets. And when I combine those two, it's a setup. It's a source of income for me to extract income from the markets. So as traders or as investors, you'll quickly notice you want multiple ways, or you want multiple setups, or you want multiple ways you can bring income from the market. So let's say in 2020, growth stocks are working, right? And it was really, really good. And it was really easy to trade growth stocks. So you had all your growth trading screens. They were sources of income because you were executing upon those setups. Now in 2021 and 2022, what happened was it flipped the script. Commodities started working, currencies started working, Bitcoin started working, and growth was not working at that point. So you want to have that dimension to your trading. And that's how I like to think of having multiple setups to operate in the markets, because I want to do this as a full-time trader. I want to do this. I want to be that high performance trader. So I need to have that dimension where I'm not just, let's say, focusing in on growth stocks, or I'm not just focusing in on commodities, right? Because trends in the market change. The market itself is changing. So you want to continue to sharpen that blade. and continue to have different setups in the market to be a full-time trader. And that is our goal. So, Richard, any questions there before I continue?
I'll just kind of add, you don't just probably right off the bat want to have multiple setups. You want to, like Raya said, dive deep into one, master that one, then you can move on to the next one. So just kind of a clarifying point there. When you're first getting started, pick one setup, master it, and then that becomes a source of income. And then you can become more dynamic, add more tools to your toolbox later on as you experience more market cycles, more situations where you have to adapt, build nuances, all of that. Just want to add that. Rye, anything to add
No,
on that point?
that's exactly it. So let's continue to the next item on our list here. So rules and risk management. So with trading, a lot of people that I've spoken to or helped along the way have always lacked, they don't write out what their rules of engagement are, for example, right? If this is, they don't write out their edge, they don't write out their entry tactics, and they don't write out their setups. They don't have examples of them. So they're not really operating upon something as if if I were to wake up and start a new company today and I want to operate, things in a very business-like manner, they don't approach trading the same way. And I used to do the same thing. I would wake up, right? I would go to an app, open an app, and then see what's trending on that app, and that would be the basis of my trading. You really don't want to do that. You want to have some rules in place based on your edges, entry tactics, and setups. You write those out, and you define your goals as well, right? This quarter, I want to improve upon, and my focus is my position sizing has to improve. I'm not, when I'm placing big position sizes, the market is coming in and I'm losing a lot of money. And then when I'm placing small position sizes, the market is trending higher. That could be a problem that you define, which then relates to a goal for that quarter or for that year. So write down rules of engagement. This is when I'll engage with the markets. This is when I'll place a trade so that you're consistent and you're less distracted, right? This quarter, I want to get better at looking at earnings and how, winners that come out of earnings, how they make it to my watch list. That's a definable goal that you can have. That's a definable, something that you could write down in your trading plan or your business plan, right? And then you get better at it. You strive towards it. The second is just your buy rules and sell rules, right? It's very simple. If you don't define how you will engage, if you don't have a list of, if a stock makes it on my focus list and this happens at the open, that is how I will, end up placing a trade. So if you don't have that decision making or that flow that ends up being pressing that buy button and buying 5,000, 6,000 shares of something, or position sizing well into a name, you're introducing randomness, and randomness will never yield any success. The second is risk management. You want to keep your lot. This is all easier said than done, right? You want to keep your losses in check. So if I'm an investor and I place a trade in Peloton back in 2020, and now it's come back all the way and I'm still holding it, what risk management principle are you applying, right? At the end of the day, if you're still holding things from 2020, 2021 in 2024, when they've, PayPal's come all the way back, Square's come all the way back, Etsy's come all the way back, you need to have some checks in place to not go into this delusional phase that many traders go into. And the way we do that is really through two things. Keep expectations in check. You're not going to get a 10,000% winner every single year as an investor. You're not going to get a 500% winner every single year as a trader. The second is tracking your numbers, right? If my average winner for my system is 20 to 25%, and a stock hits that 20 to 25% mark, can I optimize my numbers so that if I sell larger of that position in that 20-25% range based on my strategy, based on my system, based on the edge that I have in the markets, then I'm keeping those expectations in check, because I'm going to continuously make that progress in the markets and get money and extract that income from the markets. The last bit I've spoken to already here is define your system's profitability. So it's important to be in tune with reality. If my system, the best year that it's had is 80 to 100%, and I get to 40 to 50% in a tough year, that's a pretty good year, right? So most of risk management comes from going into that delusional phase where you think everything's going to 10x, everything's going to 50x, everything's going to 100x, but we need to track the reality and the numbers of it, and not get into that delusional phase.
Yeah, I'll add. I think the risk management aspect of it is a huge factor in advancing in the phases, from the unprofitable phase all the way up to profitability. I think it's probably the biggest component. If you listen to other speakers presenting, Deepak Upal was a great presentation. If you want to work on your risk management, that was excellent. You know, it comes from managing stops properly, being consistent in your process, and defining those. It comes from position sizing correctly. All those kind of factors come into play with risk management. And if you have that down, it's pretty hard if you've got a decent technical edge to not be profitable to some extent. You might not be performing exactly where you want to, but if you can master risk management, have a solid edge built in studying a setup in the market, um, you'll go pretty far. And it's the basics, but as everybody knows, doing the basics consistently and right will set you above 90% of people. So risk management. There's a reason why every single stock market wizard who I've talked to emphasizes that this is so important. It's because the math will take care of itself. If you focus on risk management, capping those losses, you'll get those outlier trades that pay for multiple risk multiples, multiple scratch trades. You just kind of have to let I think Mario said this, let the asymmetry of the market work for you. If you cap the loss side, you're gonna eventually hit a trade that performs extremely well and really moves the needle. But if you're letting those losses go out of control, everything works geometrically against you, and it's a lot harder to dig yourself out of a big hole in the market that can get a lot bigger quicker than just tiny ditches that one good trade can pay for many of them. So I really think we want to emphasize risk management as much as possible. Make sure your stops are set. Make sure the percentage away, or the technical area that you're using to set them, makes sense in terms of your system, in terms of the average gain that you're able to achieve with your system. Because once you've got that figured out, you'll go so far. So just want to add that, Ryan. I don't know if you have anything further to. Yeah.
Yeah, one thing I've noticed, Richard, is it's what traders tend to lack is it's a lack of trust in what they actually have on their hands,
Hmm.
which allows them to not exercise risk management. So if you don't know, your system's profitability and let's say 6 different metrics for it, you're never going to trust when a stock is coming down and you're now down 5% on it. You go into this phase of you go away from everything. Everything just it's all taken away, and you go into this whole different psychological thing where
Hmm.
you feel like it's gonna come back. You feel like you're gonna be whole again because the stock will come back, and you throw all of the system and all of these things that we've just spoken about so far out the window, right? And that all starts with a lack of trust in what you're doing, because you don't even track what you're doing at the end of the day. And if you trusted that, you would take that loss instantly. Hey, it's down 3%. That was my plan. I'm out. I'm done. On to the next one. Because I know that over a series of trades, what's going to happen is my system will work itself out and I'll always come out on top, that's because I've tracked my system's profitability, right? So it's a disconnection that happens where you get down on a name, you haven't studied what you're really doing, you don't know the numbers, you don't know the stats for your last 40 trade. Yeah, I'm up, maybe 2-3% as a boom bust trader, but I don't know my numbers, right? And that's really how you separate yourself from others, is you treat it like a business, you track your numbers, and you know exactly, no problem. I'll take 5% losses, but because I know the fourth one will take care of it, right? That's a lot of traders tend to um
Yeah.
lack that. So
And I want to add one more thing. Sorry if I keep jumping in, but Um, I think, many people watching this and many of the speakers have been influenced by William O'Neill for amazing reason. But I think a lot of people take what he said about having 8% stops a little bit too literally. That was kind of his max loss. I know people who work there say he liked to cut it a lot faster than that. And that 8% is kind of for the ideal situation where all the canceling characteristics are there from a first stage base. And every single person who I have talked to who's been influenced by him, cuts it a lot tighter than 8%. 3%, 5%. You want to add something, Rye? Go ahead.
He used to cut it tighter than 8%.
Yeah,
So the 8% came from a study. And what people tend to do is the 8% is when you have a perfect base formation with the perfect price and volume criteria, and you buy it at the base pivot, not earlier, at the base pivot.
right.
That's when you set that 8% stop loss. To just paint that as, oh, William O'Neill traded 8%, like, it's a lack of understanding at the end of the day as to what he meant by that 8%. He himself would cut much quicker. It's just the study yielded that 8%, which was a perfect base formation, a perfect cup and handle with the perfect dry up in the handle, right? And the market kicked in, the stock broke out. Now you're trading that momentum and you have that 8%. He said, if that 8% area, if the stock comes back in more than 8% after the breakout, you're kind of in trouble at that point, right?
Yeah,
So it's all about perspective. I mean,
right.
when I see folks misinterpret it, it's just a lack of knowledge at the end of the day and not really understanding what was said.
Yeah, and my point was a lot of the traders who traded and with O'Neill and have been heavily been influenced with them, they're trying to find those earlier pivot
Yeah.
points where you can manage risk a lot tighter than 8% and know if you're right or wrong. So early entries, buying up the right hand side off the moving averages like Ross does, where he likes to keep 1%, 2% tight stops. It works or it doesn't. If it sets up again, he'll try it again. Ryan, I know you keep it very tight. 1%. You're kind of out, and you like to buy against key levels like $20. If it undercuts that, the stock's not acting right at that point, and that's telling you to get out and reevaluate. It might set up again the next day, and then you'll try it again the next day. But you don't just want to hold a stock and hope and set a 8% stop and say, yeah, I'll just kind of see what happens. The percentage should have a purpose, and you should be buying at a point where you know quickly if it's going to work or if it's not going to work, and your stop should reflect the worst case scenario where it's not working and get you out quickly and protect your capital. So that's kind of all I wanted to add there.
Awesome. So let's get into the next thing, which is market cycles. So uh, this the first the quote that I have up on the screen is at least 50% of the whole game is the general market. There are systems that don't tap into market and they do really well, right? And there are systems that use the market mechanism and try to go with the market momentum, and the momentum, when the market momentum is not there, that you sit out. So a lot of traders that I speak to and have mentored have lacked, they say the common problem is when I enter stocks, they don't move as much, but when I sit out, I'm seeing everything break out, right? We've all been in that situation. Even the most experienced traders, when they get out of line and they can't really time the markets, that's essentially what we're doing as technical traders, right? Fundamental traders don't time the markets. It could be multiple years that they hold, Costco for, and they get dividends, and it's perfect. But market cycle aspect of it really captures the psychology, right? As I'm buying and Richard is selling, that's human emotion on the charts, right? If I'm accumulating stock and a whole bunch of traders are then out of the markets, it all depends on a market cycle, having that market cycle system. Like, how do you avoid the situation of I don't get in on time, I sell too early, I sell too late, right? I enter too early. All of that is all cured by this word, market cycle. If you have a market cycle system, then you're tapping into that psychology, you're tapping into that emotion, and all of this relates to your strategy that you have in the markets, to your edge that you have in the markets and the entry tactics, right? So a market cycle system is essentially a trade, like a trend definition for your trading system. It's a cycle count. So let's say, as an example, I have the NASDAQ 100 up on the charts, and I place the 10 SMA on it, 10-day simple moving average, right? Every time the NASDAQ is above the 10-day SMA, I'm going to start counting how many days above. And then every time it breaks below, I'll go into this negative count and say that, okay, it's below the 10-day, and now the negative cycle begins. Just having that mechanism be the basis of how you create your trading system will allow you to then refine those, and address those key problems that we just spoke about. I'm getting in too early. I'm getting in too late. I sell too fast. I sell too early. All of these issues are all cured by tapping into that human psychology, because it's all cyclical in a way, right? When we have a huge uptrend, we go into a correction. Stocks that show relative strength and are holding up then go back into new trends to the upside as the market moves right back up, right? And all of that emotion, all of that, trading psychology is all captured on charts as candlesticks. And then implementing a market cycle system will allow you to really define mathematically that, hey, I'm supposed to be long right now because it's early in the market cycle. I can position size higher because I'm early in the market cycle. Now is the right time to get in according to my system because it's early in the market cycle. So trend definition, cycle count, and you get to journal this. And when you journal it, you're going to notice three things. You're going to notice when the market becomes extended for your system, when there is a pullback within your system, and when you can expect, being up 20% on your stocks and giving back 7 or 8% back. The market cycle will capture that. And then you'll notice repetitive and cyclical behavior as you journal these three things. And it's going to cure some of the common issues that I see traders talk about again and again. It's all taken care of that by this market cycle system and your trend definition. Let's get into screening a little bit. So screening and routines is again a basis of, if you have excellent processes, you're going to have excellent outcomes. So if I'm screening the market as a technical trader and I want to develop, situational or market awareness, I can take a look at, I need to have some sort of routine in place. And the idea of the whole presentation and having these rules and risk management systems and entry tactics and edges is to all reduce randomness. Because we come in and we do random things, we have random inputs and we have random outcomes, and they're not measurable. So a screening, having a clear routine that goes through the markets gives you a really good idea and gives you that mental feedback loop will be key for you to improve upon week over week, day over day. Hey, I saw this, I saw NVIDIA back in May on my scans, and then it broke out. When you have that mental feedback loop, you get more confident in what you're doing. And when you get more confident, then, you spend more time doing it. And that's what really leads to mastery at the end of the day. With screening, there's really two things, and Richard's really coined these two terms. There's general screens and then there's specialist screens. General screens give you a big, overall feel for the markets. So is the market in a trend that fits your system? Is it in an uptrend? Is it in a downtrend? And then you have specialist screens. Specialist screens tie into the edge that you have. If I have a fundamental edge, I can screen for that, increasing estimates, increasing sales, the first positive earnings quarter for a company. Those could be fundamental edges that you have. Or the high volume edge, which we'll cover with examples at the end of this presentation. You could have specialist screens tied to that. But what I'm trying to get to is you want to screen the market some way, be it technical, fundamental, transactions data, COT, etc. You want to screen the markets in some sort of way to build that, awareness, to have a list of trade ideas and have a really repeatable way you're screening. I do it on I have a daily routine and I have a weekend routine. daily routine when the market closes. I have 4 or 5 steps that I perform. I'm in tune with the markets. I've developed that market awareness for the next trading session. On the weekends, it's a little more elaborate. I take, I look at 1,500 stocks, 2,000 stocks, get a full feel for what's going on. And then I go into Monday with, a lot more of, information so that I can execute upon that depending on what I see on Monday and Tuesday. So routines reduce randomness. It's a consistent set of steps and tasks that you perform. They help you get better. The biggest thing here is when you do a routine 50, 60, 70 days in a row, you get this mental feedback loop that develops and you see things a lot differently than if you don't have a consistent routine in the markets. Let's get into trade execution. So the next thing that the trader, you have a beautiful risk management system, you have edges, entry tactics, and you've figured all of that out. You have a market cycle system. And what happens is now it's 9:30. If you're trading the US markets and you don't really have a way to execute or you don't have a framework for that. So it's important to also, have it's kind of like how athletes prepare for game day is a little bit different when they don't have a game day. As traders, ours is really similar. If the market is, we wake up with a different mindset on a Saturday morning than we do on a Monday morning, because on a Monday, we know that, we have to be focused. I have to go and perform certain steps before the market opens. I have to perform certain steps after the market opens. And trading execution is about, having those steps optimized so that when you're there, you're making the best possible decisions that you can make because you're going against the best traders in the world, right? They all want part of they want part of the same pie, and someone has to lose for someone else to win at the end of the day. So there's 3 things. You want a series of defined steps. For me, it's, I wake up no later than 6 a.m. I have, I look at pre-market. I look at a little bit of news as to what's going on in the markets, if we're gapping up or down. I go back to my focus list that I've built for the session, the evening prior. I go through that. I go through my portfolio to see if any of the names were impacted by news, gap ups, gap downs, and I've performed these series of steps every single day. Second is traders are, they get distracted really easily. So it helps you focus. The third is you want to have a decision-making matrix. So something that helped a lot of people is, if you're saying I'm buying 600 trades or I'm placing 600 trades in a year, or if I'm placing 600 trades in a quarter, it usually points to a lack of decision. You're buying everything, you're selling everything, you're random and as to how you end up pressing that buy button. So a decision making, like when I see volume through a pivot and the market is up on the day, is only then I will buy stocks, right? So having that clear, 1, 2, 3 mental checklist or 1, 2, 3 physical checklist for your, on how you end up buying a stock is also important. The last bit is, again, we're trying to define steps. We're trying to reduce randomness. It creates this mental feedback loop where, hey, I did this on this particular stock that day and the market was good. That's why it worked. And you get better mentally, and it all comes back into your trading. You get more confident. You spend more time looking at what you're doing because you could taste that success. And once you taste that success, you're more motivated to be more disciplined when it comes to the markets.
And jumping in to go on that last point, feedback loop, and this ties into trading execution and the routines on the previous slide. If there's a stock that you missed and you should have gotten it, it's like the picture perfect stock for your system. Maybe it's Nvidia breaking out through 500. Everybody else seemed to catch it and you just didn't. You have to examine your system and see where it fell through the cracks, because that's, it feels bad to miss Nvidia, but it's going to feel even worse if that same chink in your armor causes you to mix the next Nvidia. So you have to go back and see, all right, did it not come up on my scans? Did I not review my leaders watch list? All right, it made it to my focus list. Why wasn't I focused on it as my top 3 ideas that day? Oh, okay, so it had this, subtle thing in its chart, but that's not a big of deal. Looking back at it, I'll make a note to look at this going forward. until you examine your process, if you and have kind of a reward system where, okay, I did this well, I did this poorly, until you set that up and actually look back on your process, you can improve. It's like an AI agent. Without a reward system, they just be doing random actions and there'd be no improvement in the algorithms. You have to kind of set the same thing for yourself where you look at what went wrong, you look at what you did right, do more of what did right, do less of what did wrong, and you'll just kind of iterate over time. My trading execution, this is something that I really focused on last year and this year, and the change I made was to focus only on 3 stocks max a day. Before that, I had kind of my entire weekly focus list, which could be 10, 15. I would, be watching all of them during the front of the day. When I switched that and focused more to 3 stocks, I ended up catching more of the best trades. It's kind of counterintuitive that I'm watching less stocks and catching more, but it just kind of works with trading. If you can focus more on execution and getting that part right, looking, where the best stocks fell through your system, over time you'll just improve and improve and improve. And this is such a key to get good entries, which helps you manage risk. And there's like a whole bunch of positive kind of outflows based on improving your trading execution and your entire process as a whole. So I'm not quite sure where I was going with that, but hopefully that's helpful for some people watching.
Yeah, and it used to be a huge problem for myself as well, because what I used to do is I used to trade equities, then 3-time ETFs, gold, oil, and the currency market, and I would try to keep track of all those baskets
Right.
all in, a single place. And what happens is you get washed out in all of them because you can't really focus on this one area at all. And they all trade differently, right? And it took me a couple of years just to figure, okay, I'm not good at 3x ETFs. I'm just blowing up my account. I'm not good at currency market because I don't understand news too well, right? And I'm not able to comprehend and interpret it, mostly because of lack of just age, experience, being in the world for enough time. So got rid of that. Then you really want to find what you feel you're good at, and that's how I kind of got to it as well. You saying you have 3 stocks on your watch list, I keep it 5 to 7, and I used to have 15 plus, right? Now, some traders find a lot of edge in, having 15, but placing alerts on 3 or 4 of them. And that's
Right.
how they operate because they feel more confident that way. But at the end of the day, it all comes back to, if you go back, like Richard said, and look at why was that missed. If you feel that I have an edge in the markets and it broke out without me, you need to go back and look at where in your process was that lapse? Where did it happen? And if you go back, you'll come back a stronger trader the very next day, really. So let's talk about studies and model books. So we're getting to the end of the presentation. 90% of the people in the stock market haven't done enough homework. That includes people that say 8% stops don't work. So studies, be curious about things. I feel like a lot of people, you can, it it doesn't it's going to trading's going to hurt, especially in the first 5 to 6 years. As you go through it, you'll try different things, and it's important, I feel, for you as you build, to go through that phase and go through, and a trader that's blown up an account knows that feeling, so they will never go back to that feeling. And I feel like, as you go through and you've done this, and you've been there and done that, it makes you better, right? So go try different things, go find what works for you, and eventually what will happen is you'll make an observation. William O'Neill, Stan Weinstein, Darvis, you name it, Oliver Kell, they all made some sort of observation in the markets. When Oliver Kell came up with his wedge pop, wedge drop, and these things, it's not that he woke up one day. He made an observation, and then he formalized that into a system, right? And it didn't happen, one day he just started drawing lines on a chart. He tried all these different things, and then he found his thing that worked for him and how he thought of the markets. So trader A and trader B are always different, and you're always going to be different than me and Richard. So it's important to be curious, go make that observation. You'll have this aha moment at the end of the day, and then you will make it your own as well.
This is
Um,
this is how you come up with your market cycle system. This is how you come up with your setups, your edges, all of that. Um, and just to, because you mentioned Oliver, if you're looking for a market cycle system and want a foundation, study his price cycle system. It really helps me a lot. Mine is based on the 21 EMA, but it's heavily influenced by wedge pops, EMA crossbacks, basin breaks, all the way up. It really helps having that framework to interpret price action. Allows you to know when to be aggressive, know what to expect next, and have that expectation. Maybe the market does something different, and that's information. But having that expectation is huge, and it's going back a few slides. But having that market cycle system, learn Oliver's. If you don't have any market cycle system right now, study Oliver's. We've got Price Cycle Mastery, I think, a free resource in the TL University. That's the place that you can go first, and study that, and then you can make your own tweaks, and maybe you decide it's not for you. But then it's just kind of a place to start and a place to learn how an experienced and excellent trader does it. And just having that knowledge will help you develop your own. So I just want to step in and add that.
And much of the same way, like the way folks come up with new names for the same things or new observations that they make, which we go back and say, okay, this has already been observed by someone. All those are good things in my opinion, because they went to the core of the issue. They went to price and volume. If you're a technical trader, or if you're a fundamental trader, they found some other edge, but they went to the core of the issue. They did the brainstorming. They went through the nitty gritty of it to do a study, which then makes them whatever they end up naming, whatever they end up coming up with, right? It they're so confident in that because they've done that dirty work at the end of the day. So if you start with Oliver was, obviously inspired by Stan Weinstein, right? Because there's Stan Weinstein's system. It's a cycle, right? Stage 1, stage 2, stage 3, stage 4. Stan Weinstein was inspired by someone else. He went and studied someone else. He went and studied, or he made an observation in the markets, and then he came up with, hey, stocks and stage, when they do this above the 30-week moving average, they're going up. Let's call this stage 2 of a stock, right? So the second part of this slide is model books. I think this is on an individual trader perspective, very, very important. Especially if you have an edge, you can create a model book of that edge. So if I am trading high volume gaps in the market, I have a model book of those every year, right? Going back 10 years, I can flip examples of each of these. I have them printed. I have them marked up. It gives me so much confidence that when I see a gap that I can interpret it better than anybody out there. That's because of having a setup model book, which is essentially, again, a setup is an edge plus an entry tactic. You define that on the charts. If you're a technical trader, if you're a fundamental trader, you do the same thing. You take a screenshot of the fundamentals that you feel like were good on a particular software name 6 years ago. Now you're trying to mimic that, right? You're trying to find a similar story in the markets. So you make a model book out of that. All this does is allows you to connect the prior market action, which is essentially human psychology that happened on these winners in the market a long time ago, to the current state of the market, where the human psychology and the story will be very similar, but the price action is going to increase the same way, right? You're connecting your prior states to your current states. That's what model books are. The last bit is it helps in, your trading execution. It's another feedback loop that happens as you go through and mark these things up. They sink in, your brain takes in that information, you go to sleep, come back, you're better the next day because you're doing that homework, and you're building that confidence. Confidence is the biggest thing. If you come in and you're kind of iffy and you're kind of scared of the markets, or you go into a boxing match and you're super scared of who you're facing, you're probably not going to do really well, right? So that's where model books come into play.
And was it Okta that helped you trade Livongo? Was that
Yeah.
the model books? Can you talk a little bit about that and how that kind of helped you, because you killed that trade in Livongo back in 2020?
So my Livongo trade, and this it's still my best trade that I've made since I started trading, was a basis of me missing another stock, which was OKTA, Okta Software, and it gapped down in a way, and I ignored that stock, and we were in a correction at the same time. The stock was being accumulated, gap down, and it built a really tight formation. And then when I saw that in LVGO Livongo, it was just like that. I'm like, this is the same situation. I've seen this before. It's in a correction. It's gap down. Average daily volume has increased. It so did it. I went right back to that chart and took a look at that chart. I'm like, this is the same thing. They were both very young stocks. They were both had really good float numbers. So I knew that they could move quite fast if the market gets going. They were both part of a theme that was developing in the markets. And it was like just like that. But if I hadn't done that, I meant, hey, why did this company why did it end up moving 150%, 200%? OKTA. That was an observation. I was curious of that, right? But then when I saw it again, I applied it to a different stock, and now it's like, oh, it's my best trade ever. It took my equity curve and put it in a vertical. um, it just shot it right up. So and this happens pretty much every day, every year in the markets. Arlo, a recent trade, ARLO. I placed that because I saw the exact same formation in AEHR at the exact same price point, $5. And both of them, if you place them side by side, they're both HVs at $5 going into 7.5, $7.50. They both consolidated the same way and came back and held the $5 area, and they both tripled from there. So again, it was AEHR. I didn't execute well upon it. Arlo, I see that situation. I have to do this. Like it's not, and that's a mechanism of building model books, taking what I missed. That feedback loop comes into play. If I miss it, I'm still going to mark it up. I'm still going to go screenshot and place it somewhere so that when I review it, when that situation comes up again, I'm going to be in that next one. Even if I miss that next one, I'm going to do the same thing. Eventually I'll catch one, which is going to turn into a big winner for me. Trading analysis and journaling. We spoke a little bit about this in risk management, right? Trading analysis and journaling. You want to know your numbers. I think it's important to have a trade log, right? If you don't have a trade log and you can't see your last 50 trades just like that and pull them up, you're a step behind. If you don't take those trades and mark them up on a quarterly basis, yearly basis, whatever it is, I think it's very important. You'll see many experienced traders say that they don't journal anymore. You're likely not at that point. So take that with perspective, in my opinion. So if you're an unprofitable trader, a boom and bust, and a profitable trader, and not a high performance trader, you need journaling. You need to know your numbers. You need to track which edges are your best edges in the markets, which setups, which sources of income are your best ones, so that when you're struggling and you're having a down week, a down month, a down quarter, you go back to your best move in the markets, which is your best setup, which is your best source of income. So know your KPIs, risk to reward ratio, average loss, max loss, average winner, batting average. These are some of the very basic numbers. If you don't know these today, I would say stop. Don't do anything on Monday. Just focus on getting these numbers first for your system and then continue, right? It's not a race to, if you miss Monday or Tuesday, it's not the biggest thing in the world. What's more important is to know these numbers. If you know these numbers, you're going to be more confident going into Monday or next week in the markets. The last bit is it never ends, really. So your future growth, you can have the best risk management system, position sizing system. You can have the best market cycle system, but you will always need to tweak them. You will always need to make them better. You will always need to go out there and read what's happening in the markets in a new way. You need to go out there and study or, create a new edge that you never thought you would in the markets. And what that does is, one, it expands your knowledge, keeps your brain sharp, because all we're doing is waking up, making decisions, going back to sleep. And it can get tiring if you just execute upon a routine and follow 3 steps a day and then you go back. Your brain won't function quite so well if you just do that 365 days in a row. And you got to find, I would say the last bit of it is you know, find some balance. A lot of traders will go 200% effort, right? And 0% reward because they're in that unprofitable phase. They tend to give up. So what you want to do is pace yourself a little bit. We all sit there and we try our best to really get, make it to that high performance trader phase as much as we possibly can. But it's important to find that balance. It's important to pace yourself. Again, we said this a couple of slides ago. It's a journey. It's going to take time. So application of knowledge through a span of time will create experience. You can't shortcut experience no matter what you do. So find that balance. Your time off will actually serve you better than sitting, at your desk for quite a while in the markets. So that's the end of the checklist. I hope you go through each of them and really say, okay, I don't have a market cycle system because I know it's not really talked about much. I don't have a position sizing system. I don't have a risk management system. And these are the things for the next quarter. These are this is one of my goals. I need to have these in place. I don't have written buys and sell rules. I don't have written rules of engagement. I don't have a very clear understanding of what I will do as I go into market open. All of those things. There will be many, many of you out there because I've helped many, many, thousands of traders put those in place that need it to go from that boom and bust phase to that profitable trader, from the profitable trader to the high performance trader that can achieve double digit and triple digit returns. So that's the end of my presentation, Richard. I don't know if you have any questions that we follow up with.
I, I've got some of kind of, added stuff along the way. I think what would be good is to kind of show how you employ some of the stuff you taught. I know you've got some examples of, an edge that you've really focused on, HV edges. So yeah, let's walk through some charts there and kind of explain as you go your thought process from a high level. How did this come up on your radar? What would be the setup, what would be the edge, entry tactic, all of that. I think that'd be good to show the application of all this. And you've got some closing thoughts as well, right?
Yeah, yeah. So, closing thoughts is failure is good. Use it as a weapon to improve. We're all gonna have losses. We're gonna have bad months, weeks, and years. But I think it's required for us to be, to get better. And don't, never give up. Essentially, a good trader is a trader that never gave up in the first place. So, and the last bit of it is always learn, but don't go out there and just
Follow
blindly
blindly.
follow someone. So
Yep.
if someone, just don't just, don't let someone else dictate your actions. Bring that knowledge that they have into your system and always execute upon, the execution has to come from you at the end of the day. So the last bit, I'll cover this and we'll go into the slides, Richard. Is if any of what you heard today is lacking, I've been building personally a course on that. We're going to call it UTG Pro, the Ultimate Trading Guide Pro. Essentially, the goal here is over the last 3 to 6 months, we've been building all of these mechanisms to walk traders through how they can build a full trading system. So how do you identify a trade? How do you build a position sizing system? How do you build a risk management system? How do you write buy and sell rules? How do you build a market cycle system for your trading? How do you define edge entry tactics and setups and how they play together? What's a decision matrix? And then all the feedback loops that exist to make you a better trader. So if this is something that interests you, there's a QR code. You can pull up your phone or you just go to traderline.com/UTG Pro. And it's available now. And I think we wanted this to be the best resource to walk a beginner through how to create a full trading system, but also a boom and bust trader or even a profitable trader to come in and improve each of these things so that you could be a high performance trader, which is the phase 4, which is what we speak about a lot. Taking traders from phase 1, 2, and 3 and converting them into phase 4. So with that, Richard, I think we could go into examples.
Yep. And we'll also have the link to this in the chat as well at the same time. So you can just click it there. Highly recommend checking it out. We've been working on this for quite some time. All right, so yeah, so here we are in deep view. I know you've got some charts prepared. Yeah, take it away. I'll let you walk it through.
Yeah, so I'll bring up the annotation tool. Let me know if you can see it. So this is one of the trades that I placed recently in the markets, and I'm just going to walk through everything that we kind of spoke about from a mindset perspective and what happened, and how I traded this and what I did, right? So this particular stock on earnings gapped up from about $10 to the range of about $14-15, and it registered a volume signature. And one of the edges that I have in the markets is the highest volume. So the highest volume, I quantify them into different buckets. So there's a highest volume in a year, highest volume since last earnings, highest volume ever. And this particular name gapped up on the highest volume ever. This is my number one, I would say, edge in the markets. When a stock gaps up on the highest volume ever, it has my full attention, because whatever's happened has created such enormous demand for this particular name that it's trading the most amount of volume, or it's having the most amount of interest it's ever had from institutions, retail traders, what have you, but it all creates volume at the end of the day. And when this happens with a good closing range, right, where the stock opened and closed really well and up on the day, it has, this is the top of the top for me in the markets. I pencil this in. I have a Sharpie. I put it on a piece of paper, because I want this name to be the center of my attention, and make sure that if I trade this well, based on the studies that I've done, based on the edge that I have, I know the entry tactics that I could use to get involved in such names. I clearly, pay attention to this. So I had it on my focus list on this particular day. I screen for this volume signature every single day in the markets. It's part of my daily routine. So it makes it to my focus list. So when it makes it to my focus list, that's something I look at the next day, day 2, and I have entry tactics. So the entry tactics that I use is I draw a line across the HVC. One of the presenters last weekend, John, right, had a really good presentation on HVCs that are created from HVEs. So if you have an HV, a high volume gap up, you will then have a high volume close. And I entered this particular name through its HV C right here. And then, it's about risk management, trade management from there on, but it all starts with an edge in the markets, which is the high volume edge. This one trended really well. One of the things that I will point out is, if you look at the market itself, was pretty good in this spot as well. So this orange line is the market itself, was, kind of coming off the lows. It was turning. And then the market cycle system that I have was starting to say that, we're about to turn right here. The fact that the market lined up eventually and went up, which is the orange line that you see, which is the S&P 500. We have an HVE, the highest volume the stock's ever traded. We have an entry tactic of HVC. I can now define my risk. It's usually 2.5% below my entry max. This one ripped up the next day. And now all I'm doing is I'm in trade management. That's all I'm doing. So my risk, what happens is I have a sell rule where if the 21 day, which is this orange line, moves above my entry area, I then look for 2 closes below that 21 day for me to exit the stock. That never happened over here. It was 1 day, 2 day. I gave it an extra and it kept going, right? So the first part of it, again, trade identification, which is based on an edge. Entry tactic, which is based on, if you have an edge, then you develop an entry tactic. Then it goes into trade management, with a 21 day being holding up on this particular name. And I sold it right here on this day. And that was really a perfect trade. None of my other trades this year have been this perfect. So I don't want to come across as like, he timed it here and he's right there on it and he's super perfect. No, it was just, I felt that the market was, everything around, this particular name was crumbling and pulling back in already. And I just had, it hit 35 and I sold the whole stock that day. And that's what I did on this day. Now, it's setting up well again. This was more in anticipation. It increased my average winner that I had this year. It improved my stats. Most importantly, this particular edge is a source of income for me in the markets, and it worked again. It made me, it went from 15 to 35 in a very short span of time. And not to mention that the market cycle was really, really good, right? The market was really backing the whole thing. Let's get into the next name, which is ASTS. So this one is one I missed. I haven't traded this one, but I want to showcase, if you miss it, you have to come back and take a look at it. What happened? Why did it not make your list? And why did I not trade it, right? From a process perspective. So it gapped up initially here, which was again based on earnings. It had the highest volume it's ever traded on this particular name. This particular day, I had it on my radar. So, but the issue was the price on the name was way too low. So I usually have a filter of $5 or more on my HV screen. So I did not catch it in this area because I've generally found that stocks that tend to gap up into this area, it's a little too early. And they usually have this secondary, high volume gap, which then will, get me interested. Same thing happened on Arlo. Same thing happened on AEHR. This is very similar to that. If you go back and pull those charts up and you line them up in terms of time, you will see the same kind of price behavior. Now, this doesn't mean that I throw out my whole system and I start trading stocks that are in $3 just because they have HVs. That's fine. But what happened here is more important, right? It had a secondary gap up in the markets. It had even higher volume than it did on this particular day. And it had the highest volume ever again. Now, this situation is the same situation as the other ones I mentioned earlier today. AHR, Arlo, it gaps up into the 7.5 range. It gaps up into that range and it puts in the highest volume ever. I should have had this on my radar, right? And I didn't. It was a process lapse. Whatever happened, I did not have it. And this company, it's the exact same situation. This thing's gone from 5 to 18. It's happened before from a technical price perspective. It comes back in, the volume dries up. You get this particular day where the volume is very dry, and it rips through this 10 spot and never looks back. It's really picture perfect, but I missed it. I did not trade this. This would have been one of those, what I call performance boosters for your portfolio, where even a 10% position size on this would have yielded such a good return because it's just gone from 7.5 to 18, right? As well. So this was, reinforces the concept that you want to look for HVEs, right? And what I'm starting to notice in recent trends is that when these things happen around this 7.5, which I might call the magic number or something, they really go. Like this happens every year. When I traded Arlo, I said this is my AEHR for this year, and I said that repeatedly to people, and just to reinforce. I tend to say things because it allows me to connect past states to current. It gives me more confidence. It gives me, yes, yeah, this is happening type of thing. But this would have been exactly one of those trades.
And
Let's get
just to clarify a question for this one,
yeah.
the initial gap up, I think it wasn't earnings this time. It was on a news catalyst. They had an agreement with AT&T. Does the reason behind an HV matter to you? How do you decide what's important? I think that's a really good nuance that I'd love to hear your thoughts on.
That is something I would say I need to get better at. The reason I don't include it in my trading is because I feel like it's very subjective. And if I were to start doing that, I would need to do it for multiple years for me to really get good at it. I can read, news can be spun positive or negative depending on what you see in price at the end of the day. I strongly believe that if the price on this day, if it gapped up on AT&T or whatever, and the bar next day was here, right? My observation of that positive bullish event is now negated by price. And if it is negated by price, it doesn't matter. AT&T or the best service in the world partnered up with them, it doesn't really matter, right? So if price tightens, I think it's it's reflective of the fact that there's a lack of sellers. And that's really the news on my radar, that there's a lack of sellers, there's a dry up in volume. The story's probably good, right? Whereas you'll see gaps that happen, GME, pull it up. You'll see that parabolic price movement. The story itself is not that great. Like the company's not going to turn into a Netflix all of a sudden. So a few days later, you'll see that price bar come back down. Reality sinks in. But when you see tight price action, the reality is a little bit different because it's being accumulated and nobody wants to sell this thing, right? And that is the story at the end of the day. Price is the story.
Great.
But, if you could get good at it, you go track this and you can say that, oh, this drug was, passed. And then in the future, a couple of years later, you feel it's the same situation, right? And then you could connect those different states. You could get really good at it. I just feel like it's all there in the tight price action. So I don't need to do it. Let's go to Tesla. This one was a good one. I traded this one. This one was a good one from a sentiment perspective as well. On this particular day, I really felt like the sentiment was starting to get negative. And then you see, the market does the opposite and just rips up. But what's most important is it put in a volume signature. So any stock that goes from a stage 2 to a stage 3 down to a stage 4 comes back into a stage 1. Usually, good stories. They're trying to, build electric vehicles, sell a whole bunch of them, robo-taxis and all that stuff that Elon says was done 6 years ago. It put in a HV, right? So, that's all that matters. This is the HV1, and this tells me that there's a base that's about to form here after a longer downtrend, multi-month. Everyone under the sun is shorting this thing. We have a HV1, and this is where I entered this particular name. I drew a line at the HVC, which is the high volume close when you have a HV gap up. And I like to define my high volume gap up. So when I say HV1, this is the highest volume in 1 year, right? That this stock has ever traded. You just draw a line and you see that this is the highest volume in the year. I entered this, I had pretty tight stops because I wanted this to work right around the HV. I know Tesla tends to frustrate, like this type of trading I don't want to get involved in. I know that it's been in a downtrend, but what gave me confidence was the market was still pretty solid. And the Tesla, the way it trades, it's either going to do this and give you a really good, reward, or the next day I was going to get stopped out 2.5% and get out of it, right? Luckily, what happened was, we got follow-on, follow-through volume. We got these 4 or 5 days where I'm just sitting there and saying, perfect, it's gapping up again. It's gapping up again, right? So gapped up, gapped up, gapped up, got a little frothy. And then on this day is when I sold it. This particular day when it got below this bar and it got below that bar, sold a bit over here, sold the second half over here. And I said, okay, it's time to pause. It's still the same company, right? But so this particular bar, this volume was huge. Early in the session, where the volume was really big as well. If you pull up a 5-minute, you'll see that. And then when it broke this second time, the relative volume increased. And when it did that, I said, okay, it's going to come in and consolidate. I don't want to be part of that. So now it's back here. We'll see what happens. But point of emphasis, it all started at HV1 and it put in this volume signature. That's my edge. This is my entry tactic. My risk management is based on relative volume and also getting extended off the 10-day. You just have a feel for it. You'll develop that as you go through and trade the markets. And then it came back in. You're not trying to top it. You're just trying to get the meat of the move at the end of the day. AEIE is the last one. This one was pretty good. Same thing, I would say. This one's a little elevated. So this one was HV1. I traded this one as well. So this one back in April, right here. I got in somewhere around this area because the market was about to turn. The market wasn't too great when it did this rally, so I just watched it go. So I know that it was showing relative strength and really good volume. I tracked it, had it on my watch list, continued to watch it, but I didn't get involved until I felt like the market could turn. And when it did, I traded this particular area. HVC was out of, it was hard to get there, but I got somewhere, I think on the 15 area, right around here. Whole number entry tactic. It worked, held, and then took off. This one trades a little bit wacky. I didn't like how it traded. Like you would break out and then you give all of it back. You break out, you give all of it back. So position sizing wasn't that high. The volume itself wasn't like, if this same volume was like here and it was 20 million, I would have had a lot more position sizing on this. So this was more a performance booster secondary name. The market was turning. Really what did it for me was it caught my eye in this area. Like it rallied while the market was coming back in. And I'm like, okay, that only happens when there's accumulation, right? In the markets. So these 4 examples, again, you're not going to catch them all. Like I didn't catch ASTS. I did catch the Tesla and WGS, but they're all based on the same thing, the same edge, the same entry tactics. How I manage is very similar. It's just different situations and different charts at the end of the day.
And this one, it looks like it's actually HVE today when we're recording this.
Yeah, so this one, again, I feel like the volume is not too high, right? It's only 1
Overall.
million.
Yeah.
Yeah. I need the volume to be like, if this same thing was 10, 15 million, it would have been so much better. But we'll track it. I mean, it will be a lower position size just based on the fact that I have a hard time trusting. Like it can come in tomorrow and just do this because someone that has a lot of stock just puts in a bigger bar than them, right? And 1 million is not much in terms of dollar volume. So
Yeah, the average dollar volume on this one is it's under 4 million. So that's
yeah.
pretty tiny. Perfect. Rai, this has been excellent. Enjoyed your amazing handwriting as well with the screen pen, whatever you're using. But yeah, I appreciate it. I think this helps, show both the theory with your presentation as well as how you apply it. I think that's important. And we've got so many other resources if you want to dive deeper. Teal University, if you want to check that out. Rai, what kind of closing remarks do you have for people? What kind of last words of advice you have? What kind of homework would you assign them if they want to improve their trading?
Yeah, I think we've put a lot of effort. What I'm trying to do over the past couple of months is try to build something that traders can come in and, really we make it really easy for them, right? We give them the proper templates, we give them the proper steps, we walk them through each of these things. So a lot of my effort over the past couple of months have gone into building something like that. If you lack any of these things, feel free to, reach out on X. It's not that, we're doing something really crazy. I'm happy to help out, comment, tag me, whatever. But check UTG out. I would say, we're gonna build clear, systems for you, which they're all gonna come back, and talk to each other and build a perfect feedback loop so that you can graduate from one phase to the other. The last bit of it, I would say, is just make it about yourself and not about others. I mean, any successful person, any successful trader made it about themselves and about their trading and about their strategy and really dug deeper into what they want to master at the end of the day. If you don't have that mindset and you have the followers mindset, you will not make it because it's really, really hard to just follow someone's footsteps to success. You want to create your own and you want to be, part of, we want to be mentioned in those names, not just be underneath them at the end of the day. So that is all, Richard.
Excellent. Well, thanks so much, Rai, for your time. Hopefully, everybody watching enjoyed this and got some good gold nuggets from it. Let us know your feedback in the chat. And definitely leave a like down below if you're enjoying today's conference presentations. Make sure you're subscribed. Make sure if you're finding value that you pay it forward. Go ahead and donate to St. Jude's. We'd really appreciate it. If you've gotten one great thing from Rai, go ahead and donate $1 if you can.